National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And today, what every producer should know about taxes with special guest Ken Davis, CPA. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant. Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals right here out of Fountain Hills, Arizona, home of America's largest fountain. And with me today, of course, day 3 with our interview with Ken Davis, CLU, ChFC, and CPA. Ken, welcome to the show again.
Hey, Stephen. Good to see you.
Good to see you as well. And Ken, we've had you on this show for so many things: charitable giving, end of the year tax, Section 79. If you haven't catch that, you need to go out there. We've been talking about taxes. The only reason we're talking about taxes is so that you can position your practice to really understand how to sell our products, life, annuity, sometimes LTC, sometimes deductible DI, depends upon what we're looking at, to really position it. And part of that is the docs we're giving away. We're giving away this great 2-page summary sheet. You can laminate it. It's great. I would do it. I'd carry it with me everywhere. It's in my backpack. And it's a great summary by Lincoln Benefit Life, the 2012 tax update. And there's this cool thing that AXA made, this 1040 overlay. The transparency is so great. It's not only an educational tool, but it's really a great process for sales. And it's all about tax reduction. And I don't know about you, but with the political climate that's going on right now, paying less taxes is where it's at.
Well, and the mindset of our clients, for our agents, is that one of the things that gets clients' attention is reduction of taxes. It's an emotional issue. We all know that sales are based on emotion, and so if you can get them interested in the tax aspect of it, we can end up doing so much more for them that really isn't tax related.
But can you just say something that I think is not known in our little court? We get that now. Sales are emotional sales. But I still have about 20-25% of our audience that's analytics, similar to somebody I know.
Who could that be?
I don't know. I'm just saying.
Don't know.
And that really think that if they could put together a plan that was so good, the math worked, it was great chronology, great timeline, explain the definitions, and nobody would ever refuse to buy because it was so logical, it had rationale to it. But that's not the way it goes.
No, people need to get excited or emotional about things to take action, and the fact is that pure logic, unfortunately, doesn't necessarily move people.
Boy,
I've seen things where studies where they talk about benefiting employees and they talk about salary changes. Well, you pay somebody another 50 cents an hour, and that's $1,000 a year basically, versus spending $1,000 and sending them off to Vegas for a weekend. Which are they going to get most excited about? They're going to get excited about the trip to Vegas.
Well, after the NFL playoffs, I'm not too interested in gambling at all, to be honest with you.
Well, I didn't say gambling. There's shows and other things.
Oh, investing, yes. Investing.
Well, there's a lot of people, get excited. People get excited when you give them a little pin or recognition or a pat on the back. So emotion carries the day frequently, or just a new iPad or something like that.
Hey, and by the way, I do want the newest iPad, and if my boss is watching, he asked me, that's what I want. And I just want you to know also, if you're sending stuff to Steve Savant, remember, don't send liquor, send food. Okay, just a little side note.
Right. So taxes are an emotional issue, and that'll get their attention.
So
that paves the way to do some better things for our clients.
Our audience, we're not entirely Vulcan here, because that's what I'm saying. I guess sometimes we forget that there's an emotional haiku to our sales process.
Right.
Okay. Well, Ken, let's talk about a little bit about. I don't want to get too far into this because capital gains, capital losses. Before we get into we want to talk about IRAs and other things today, but just to touch on that, just real quick.
Well, one of the interesting things when I was studying the taxation of Social Security income is I started thinking how income flows through the tax return, because it has an impact on adjusted gross income, which we've been talking about managing. Well, yes, it's true we get a 15% tax rate on long-term capital gains. However, there's a nuanced impact that's substantial. That is, if I make $100,000 in cap gain, we'd all like to be that fortunate, I'd pay $15,000 in cap gain, and that
apparently Romney is.
Yeah. Okay. So that $100,000 actually goes through to the front page of the return. It isn't $15,000 that goes to the front page. It is $100,000 that goes to the front page.
Okay. Now, why do I care about that?
Well, because ultimately that flows down to adjusted gross income. So AGI is actually increased by $100,000. Well, gosh, AGI, adjusted gross income, then is used for whether certain deductions, exemptions, credits are phased out. how much of your Social Security is taxed, what your Medicare premiums are going to be. I mean, all these things.
Okay,
limits on IRA contributions.
Make sure I understand what you're saying then. So I may very well be paying capital gains 15% on 100 grand, which is 15 grand. Okay,
right.
Stop. But now this still flows through to my overall AGI, and that could affect my Social Security taxation, my Medicare issues.
Yep.
I mean, am I really paying 15%? Well, from our more wealthy, right?
It's worse.
Geriatrics. I mean, wow, yeah, we're paying way more than that.
And it can be very substantial. I mean, that change in income can have a very large impact on other things in the tax return.
That's what I like about our products and what we sell. On life insurance and annuity specific, we sell others, but that's the big one. Those have major league impacts on your AGI and how we position it, how we schedule it, the chronology of how we buy this product and how long we hold it. It all really matters, doesn't it?
Well, sure. So if you could, the whole point is if you were living off of something paying off nice dividends and you're paying capital gains dividend, taxes at 15%, if you move it from that asset to one of our other assets, part of the process of how much financially spendable income they get after taxes is impacted. So, and quite frankly, I've never read an article or anybody really focusing on that. So that was a bit of a surprise for me when I really started to look at that. The other thing is conversion. We all got excited about Roth conversions a couple of years ago when we found out that there's various different kinds of calculators, different ways to look at it, and just minor changes in variables would change the end result. So a lot of us, it was too complex and we lost interest in it. But if you look at it from a very simple standpoint, if tax rates remain constant from the beginning of the contribution to the end, a Roth versus a regular IRA, pretty much the same net result spendable income coming out of those accounts. What's different is if you have increasing tax rates, then the Roth concept gets more attractive. And then when you're talking about AGI, well, what if I have been taking money out of an IRA in retirement to live on, and then I convert it over to a Roth from a regular? Well, I'm going to get hit on my AGI that first year, maybe quite substantially. But then each year thereafter, now when I start to the point where I'm able to take my money out of the Roth IRA later on, that won't affect my AGI. So it's a one-time hit to get a long-term impact on the result. So that's another reason to maybe do that. Plus, if the client isn't going to use the money, they're not forced to make a distribution at 7.5. So a conversion to Roth has the normal things we think about, but there's also an impact on AGI, which is part of what we're trying to do is manage that today. So move from CDs, municipal bonds, capital gain assets potentially, and then this Roth conversion could have an impact on AGI as well. So there's things we can do to manage. So part of them have to do with our products, part of them don't. But if you do a Roth conversion, you might be able to put it into some annuities inside of a new Roth IRA.
Well, I like the idea.
No, not for tax purposes.
No, right.
For indexing.
For index, right. When I look at the AGI, I'm looking at it because there was hey, should I convert and pay the taxes today? Right, that was the whole issue.
Right.
And you said, it scares me when Ken says, and it was so complicated that most of the producers, well, if he thinks it's complicated, then it just didn't get done. We did not see the conversions we thought was going to happen.
Well, yeah, and I saw a gentleman make a presentation to clients, and he just went down all the rules, just totally glass-eyed, fuzzy, just they're going, wow, this is way too much. So you have to simplify it. Is there a good reason? Yeah, tax rates are rising, and the conversion will be better for you potentially long term. And that's just a quick way to look at it. You can still do the calculations and stuff, and probably you should, but this, if people are concerned about taxes going up, which a lot of us think they are going to, that by itself might be enough of a reason.
When I'm looking at of a few things, when we get into qualified plans, we're always talking about ordinary income tax. I mean, there's just not there could be, when you get into non-qualified plans and you're dealing with capital gains and capital losses, we all know about harvesting that, trying to neutralize the tax effect on it. But really, when you said the capital gain, I could imagine people, and just Steve talking out loud, they're sitting there hearing what you just said. I had a $100,000 capital gain, and let's say I even had a little bit of capital losses. I could put up against that, right? A little bit. But I'm still calculating my total AGI on that $100,000. So even if I was tax harvesting
Well, no, the tax harvesting actually would reduce it because that
would reduce it, but it wouldn't eliminate a number like that.
No, it might go from 100 down to 50 or 70 if you tax harvest, but it's still the net effect. If you're in a net long-term capital gain, it would impact it.
Well, I'm thinking, well, in my thinking, and I think like a lot of, I think producers with that, they would go, oh, well, I did my tax harvesting, I reduced it from 100 grand down to 50. Oh, and that still goes downstairs, and I'm still paying tax on that. Yeah. So even though in our mind we think we're doing something that neutralizes taxes, which it does in some ways,
right,
it doesn't escape the full taxation that it could occur.
Yeah, the fact of the matter is there was a day back, and now I'm really dating myself, but I was practicing as a CPA in the 70s.
How's that dating yourself going? I mean, you generally mean like,
my age, dude.
Your age. Oh,
right. So...
how do you
I just aged a year with that comment. Anyway.
Wow.
Basically, we used to be able, when the client called up and said, hey, I'm going to do this and I'm going to have this capital gain or whatever, what's that going to do to the tax? Well, we could do a quick calculation in our head. Not anymore. Anybody that does that is crazy. You actually have to run these things through tax software. And by the way, here's a tip for our agents in trying to work. Fiduciaries sometimes frustrate us because they say no a lot, right? Well, what if you were proactive and you said to the client, I need to talk to your accountant because I want to make sure that these things we're doing is going to have the positive tax impact. I'm not a tax advisor, and I don't have E&O for that, so let's run that through. So they call the CPA and start talking. I'm doing some planning for Susie and George, and I want to make sure that this works. Well, what do you think? What kind of a statement does that make to the CPA? You're not avoiding him anymore. You're including him. You just increased his billable hours, right? So now his nest is getting feathered, and now you're building a relationship, and then you also have an opportunity to say, and then when he sees what the change does, and the client saves $5,000 in tax, he says, well, how'd you do that? What are you doing? So, well, we're reworking things.
But how do we do that, though? I'm all over what you're saying. Am I buying TurboTax? Am I buying a quick software? Am I doing this on the web?
No, I'm talking about asking the client to be able to talk to their CPA.
Doing it direct.
Yeah, and making them a team member, including them so that they don't become a barrier to your changes. You brought them in. Now, could they be a barrier? Sure. There's always that risk when you bring them in. But I'm telling you that if you include them as part of the team and you're not ignoring them and they feel like they've helped make the decision, they're going to support what you're trying to do a lot more than if they just discover it later on.
Well, Ken, I got to tell you, just in my almost 30 years going, every time I relate with the CPA Society, CPAs, I'm stunned by some of the maneuvers that we do here that really can cause huge tax advantaged impact, and they didn't know that.
They don't know the stuff. They really don't understand.
They're not proactive about those issues, and that's what we're doing. That's why we teach at the society. We're actually helping the fiduciary market understand what an impact it is to do tax advantage and guaranteed insured products.
Right.
Well, listen. When we come back, we'll be talking more about this on the Business Insurance Zone with a show that talks about insurance in your practice. You can call us at 1-800-290-7226, extension 147, or write me at thebiz@brokersalliance.com. Right after the commercial, Ken and I will be right back after we hear from our sponsor, Brokers Alliance, the leading distributor of insurance products in the United States.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, financial color commentator, and of course, interviewer extraordinaire. Before going forward with any of the things you hear on this show and all this week on taxes, always talk to your CPA, your tax attorney, and of course your broker-dealer compliance department. You can call us toll free at 1-800-290-7226, extension 147, for any quotes or questions you have on life insurance, annuities, LTC, DI, and group pension plans. Hey, it's not what I know, it's who I know, and that's why I have Ken Davis on my show. Ken Davis, that's CLU, ChFC, CFP, and CPA. And Ken, not only do I welcome you back to this segment, but I'm just thinking about how I memorized your credentials over all these years. I mean, I'm the only guy that gets it right. I mean, we've been in our study groups together. We had a radio show actually in Phoenix years ago, and it's cheaper to do it on the internet, you know. And so when I think about it, I want to just give our guys a little heads up. You know, think about this. This is a CPA that's a certified financial planner, and he's already went through the life insurance stuff, and this is how he loves this stuff. I mean, Ken.
Yeah.
We're talking about.
And I wasn't always there, as you well know.
No, we'll have to do a whole show feature on Ken viewing me as the snake oil salesman back in the early 90s. That alone should go viral, because there was a lot of hatred going on.
No hatred. Just that was the impression. It was a matter of trust, not hatred.
Okay, well, I'm glad that you made your conversion to the dark side, so I can say.
Well, in my mind, it's the bright side.
It's a bright side. Oh, well, I'm even up in your game on that. Well, let's talk about it for a second. You know, qualified plans. I'm looking again at the Lincoln Benefit 2012 tax summary on what we can donate for this year. And wow, we're looking at some really good numbers here that we can get the full deduction. Now, I never thought I'd have to worry about modified AGI and the full deductibility of some of these. Now we're in a whole new realm. I thought it was like, hey, here's your $3,000, your $5,000, and you're done. Right. That's not true anymore.
Right.
So talk a little bit about that, and look at these and the numbers of what we can give away on our traditional Roth IRAs, what we can do on regular IRAs, maybe even drop down to 401k, 403b, SEPs, you know, whatever numbers we have on here. And then I want to talk about the catch-up provision for us who are old enough to actually obtain it.
Okay, well, let's just go quickly down the qualified plans. We were at voluntary reductions in salary to make a contribution to a 401k, 403bs, was $16,500 last year, and is now $17,000. And these are inflation adjusted. And the way the formulas work is they don't do odd numbers; they do in increments, I think, of 500. So we crossed that threshold, and it bumped up to $17,000 for 2012. The simple IRA and simple 401k is still $11,500 for both years. The 457 plans jumped $500 to $17,000. The limit on annual additions to SEP IRA plans went from $49,000 to $50,000. Anyway, we would encourage everybody, instead of us just reading this list, there's been some relatively minor increases in that situation. And then what you're talking about with modified adjusted gross income is the deductibility of a traditional IRA. Okay, and they look at adjusted gross income to determine whether or not you get a full, partial, or no deduction, and those numbers have jumped up before they phase out. For single person, they started at 55,999, almost 56,000, and they're now almost 58,000 within a dollar. And then a partial deduction somewhere between it was 56 to 66, and I'm rounding off, and now 58 to 68. So that's a good thing. You know, we've had an inflation adjustment on those deductions, but that also points out that we have adjusted gross income, and modified adjusted gross income is just basically taking adjusted gross income and making some adjustments for it. Sort of like with the taxation Social Security, they add municipal bond interest back in, and actually add part of your Social Security to come up with a modified number. And we're not going to get into that much detail today, but we do have as part of our packet, if people want to order that from us, they can look that information up.
Now I'm looking at this catch-up provision. You know, they're for everybody. What is it, 50 and over? You're talking about your 401k, 403b, 57 SARSEP plans. All those are stayed the same. We didn't really get a bump last year. It's at 5,500. So whatever you can do, you can add another additional 5,500. Now, and if you don't know this, Ken, this is an obscure start, so don't feel bad.
Well, it's 5,000 for the base plus another 1,000 for the catch-up on the IRAs. Are you talking about the qualified plans?
Yes, I am. 5,500.
Okay. All right.
And I also think that they're giving the ability for a non-working spouse to put some money away now. Well,
they always have done that.
But I mean, it was a pretty good number, I thought.
Well,
I don't see it on the sheet, though.
Yeah, there's limits on that.
Yeah, I don't see it on the sheet. So when we're looking at this, we're looking at all the areas that are going to be deductible. I'm excluding the Roth on this. But when you think about it, I want to be able to maximize my deduction. And especially if I have employer matching on this, I definitely want to play that, because I think that's a very, very, very good area to pick up some extra return. So I always want to try to max that out. And I just want to say one thing, and Ken, you can get off on this if you want to really have a little, business insurance selling buzz on the biz today. I love life insurance and I sell annuities, but people, to say that you should be doing that and never do any qualified plans where an employer doesn't match. I mean, can we hear this stuff all over the web? Right? I mean, we got people telling people to do this.
Well, yeah, that's right. And first of all, if an employer is matching a contribution, absolutely the employee client should contribute up to the maximum where they're going to be matched. I mean, if you're getting 25, 50% match, I mean, that's just such a jump start that you're crazy not to do that. And even if you turn around a few years later and took it out and paid your penalties, you're still going to be ahead of the game. So you really can't do that. As to whether you should do a life insurance versus, say, a Roth IRA, while it's true that if you squeeze it all down, all the life insurance, and get a really good return on your indexing, that you can have a competitive, rate of return plus the life insurance. But the thing is, when you run numbers, I ran some for a seminar I did last week. We went from an 8% assumed rate of return on an index life down to 6%. And we went from a variable rate loan to a fixed loan. Actually, from 8 to 6 in variable, it went from like $8,000 a year in income to 6. Okay, and then if you go to a 6% with variable, it went all the way down to 4. So to say that this is going to be competitive, well, based on your assumptions, maybe it is, but we don't know we're going to hit those assumptions. So. And I think actually more importantly is to layer them, to mix it up, just like we mix up our stocks and bonds and money markets and CDs and IRAs and qualified plans. Throwing life insurance into the mix to do that sandwich. Think about it. We could do our life insurance, build that up, having maximized maybe some of our qualified plans and IRAs. Well, when we hit 65, we can start pulling money out of the life insurance policy and let the IRA continue to tax defer. And that's really what those devices are good at. So if you defer all the way to 70 and a half, that's another 5+ years of tax deferral. That works. Or if they want to retire early and they don't want to hit the 59.5, 10% penalty rule, so at 55 they start taking distributions out of their life policy for 10 years, or maybe even 15 years to age 70. Use the life insurance for those early income needs, and then the deferred accounts for that. So having these options helps you be strategic in where you take the money from, and you can't do this planning on the tail end. If you've already got all in qualified plans by itself, or all in life insurance and annuities, you don't have a choice. But if you have a mixture of these things, use your 401ks with a match, build up your deferred accounts, but then salt away some more liquid assets in the form of life insurance.
Well, I like the ability, and I have a lot of people, we've been doing this a long time. I mean, we started getting into income in 1990 using life insurance, and a lot of our clients now, and we're teaching this to our producers as well, a lot of our clients really came to the place where it said, I'm going to take my money out between 60 and 70, my life insurance, my withdrawals to basis, policy loans to gain, keep the contract in force, and take my Social Security because my life insurance income isn't going to show up on my 1040. I mean, that's a whole other issue.
That's right.
So that money, my Social Security and my life insurance coming out, and I'm deferring my qualified money, as you suggested, till 70.5. Now, I am going to be forced to take RMDs after that, but I kind of know that anyways. All I'm doing is letting it grow even the more and try to maybe overcome some of that taxation.
Well, let's talk about one AGI management tool we haven't really talked about. We've talked about Roth conversions, but what about taking money out of an IRA and putting it into a life insurance policy? Well, what's interesting about that is if we took a straight Roth conversion, we'd take this potentially huge amount of money out, put us in the maximum tax brackets, get it into the Roth. What if we just took a more even flow over, say, 7 years? Maybe that additional income doesn't put us in as high a tax bracket, okay? So yeah, we're paying taxes, but a little bit at a time. Maybe we have cash and other earnings over here that helps us pay for those taxes instead of this huge tax bill. And now what are we doing? Well, we're avoiding the MEC rules on the life insurance, and we're salting in this money and building it up. And maybe we do a 7-pay or a 5-pay or a 10-pay type of product. And so we're doing kind of a partial conversion as we go, trying to manage the taxes and the conversion. And now we have, the life insurance. Well, the cool thing that life insurance has that the Roth doesn't is life insurance itself. It's like, okay, if I'm doing this conversion and then I pass away and I've already paid these income taxes, that may not be so good if I don't have an estate tax problem. But with this conversion to life, we not only pay for those taxes, but then some. So the heirs actually end up with more money than if we just left it in the IRA in the first place.
And remember, Ken's a CPA talking like this. This isn't Steve on the Business Insurance Zone. I think some of the tactics, once we show people how this stuff works, how these products work on a timeline, using blended tax rates. Also, like you suggested too, we're diversifying in investments, we're diversifying in our taxation issues, we're diversifying in when we take constructive receipt of our qualified and non-qualified plans, and all to strategically take in the best net spendable income possible under the code. I mean, that's the end game. Money, take home money, and especially to my wife, take home net money you can spend. Hey, you can watch this show and all our shows are going to be on tomorrow, all in beautiful HD 1080p right on our website at www.brokersalliance.com. As soon as you come to the page, hit the red on demand button. You can watch all our shows this week and everything we've ever done. And check out our social networks on Vimeo, YouTube, Facebook, LinkedIn, and Twitter. All of this is on the show. You can see everything we're doing. And we're going to catch you tomorrow. We're going to continue our whole show on this. It's going to be great.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.